Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to this week's edition of Through the Noise. Now we've just published our latest monthly global market outlook for September, which we've titled Shifting Winds, and we have made some significant changes to our asset class views. Now, to discuss these changes and to take us through the latest thinking behind them, we have a special guest today. We're joined by Steve Brice, who is our Global Chief Investment Officer. So, Steve, thanks so much for joining us today. Real pleasure to have you here. Maybe to get started, before we get to the change in views on asset classes themselves, could we step back and check in on the global economy? Do you really see any major changes from a global macroeconomic point of view?
Thanks, Manpreet. Really great to be here. I guess it's been a while, but so let me answer your question in two ways. I think the answer is both yes and no. So clearly, we've seen some significant data releases in the US over the past month. So most notable has been on the labour market side, where we've seen a rise in unemployment, and that obviously has triggered another of our recession indicators. However, I think when you were saying that's yes, the answer on that basis is yes. But if we look at the broader no, I think the lessons that we've learned from 2023 are that these quantitative triggers, we call them outside views, are just the starting point. It's also important to think about the inside view, which sort of thinks about what's going on today that might mean these indicators will be usurped by other factors. So July data, let's just dig into that a little bit more. So it did show a more than expected increase in unemployment. On the negative side, this does in part appear to be a result of reduced demand for workers. That clearly suggests that businesses are getting a little bit more worried about the outlook. But we're also seeing an increase in the number of workers in the economy, which is, I guess, good unemployment to the extent unemployment can be good, as it increases the pace at which the economy can grow without creating excessive inflation. So now, if we take both sides of the argument and then we add in the fact that financial conditions are easing, bond yields are down, credit spreads are tight, equity markets still strong, and the US dollar has weakened in anticipation of monetary policy easing in the US in particular. This leads us to conclude that a recession is still a 20% probability, and a soft landing is by far the most likely outcome, in our opinion.
Okay, so I guess where that concludes with the last bit is that the economic situation looks okay, but in that case, why are we making significant changes to the asset allocation?
Yeah, so I guess the word significant is interesting because at the headline, I guess it's true, but I think it's also important to place these into context. So I'll try to do that. So we've been overweight global equities all year so far, and we've decided to trim this back to what we call a neutral allocation. Now, as I mentioned before, we're not looking for a hard landing, but we do believe markets have priced in a lot of good news already, including the soft landing scenario. And we see the political/geopolitical environment, so whether we're looking at the US election, situations in the Middle East and Ukraine, we see them as potential sources of short-term volatility. So that's why we're going from an overweight allocation to a neutral allocation. But putting this into perspective, our allocation to global equities has been reduced in a balanced foundation allocation from 58% to 56%. So that's a 2% reduction in allocation, which is hardly earth shattering. So I guess we always remind clients that it's important not to overreact to the short-term outlook, which is not by nature very uncertain. And I think 2023 again is a big lesson here. Almost the whole market was underweight and bearish equities in 2023, but our balanced allocation, which has over a 50% allocation to equities, delivered 11% returns that year, largely because of that equity allocation. So, therefore, we maintain a core holding for global equities within our portfolios. Within equities, we still have a preference for US, which is supported by strong earnings growth and the fact that the market is likely to benefit more from lower interest rates.
Thanks, Steve. I think that's good perspective that the equity position, of course, is trimmed by about 2%. But I suppose that begets the next question, which is that where are you reallocating that 2% towards now that you trimmed that from equities?
Yeah, so we've increased our allocation to gold. So and so we've been neutral gold. Obviously, gold has performed very well so far this year. We've always been arguing that gold plays a very important role in a long only portfolio as a diversifier. So if you have access to private markets and different asset classes, you can argue that it's less important. But certainly, if you're just having public assets in your portfolio, I think gold is very, very important. But in an environment where uncertainty is likely to increase, this becomes even more relevant, especially against the backdrop where we see central banks cutting interest rates in Q4, including in the US, and the dollar remaining weak. So, therefore, our allocation to gold has been raised from 5% to 7%.
So we haven't spoken about bonds yet. And bond yields are the other sort of market variable that did move in the context of the macro environment you described. So what are your thoughts here, Steve?
Yeah, so we continue to have a neutral allocation to bonds. Again, just trying to put this into a bit of context for a balanced risk profile, that's a 36% allocation. Yields have obviously fallen significantly over the past 3 to 4 months. We were over 5% at one point. Now we're just below 4%, and that's happened as it's become clearer that the Fed's going to cut interest rates relatively soon. In fact, we expect the Fed to start cutting rates on September 18th. So really, we've been throughout this period advocating that people look for any yield spikes to add to bonds. Now we'd say if the 10-year US government bond yield went back towards 4%, sorry, we'd see this as an attractive level to add to high quality bonds and to lengthen the maturity profile of bond holdings. So we're looking for 3 rate cuts from the Fed this year and to continue next year. So locking in yields we think is important. Within bonds, we still have a preference for emerging market US dollar government bonds, as this asset class benefits strongly from lower interest rates and yields, and also offers attractive credit spreads relative to other areas within credit. As an aside, with the outlook for lower bond yields, also suggested an income strategy, which has a higher allocation to bonds than a non-income based strategy, that this income strategy should continue to outperform cash. Our income allocation was very range bound through the first 4 months of this year, but now up 7% year to date, and that's on the back of those bond yields coming down largely.
All right. So I think we've gone through obviously the key sort of components of the foundation portfolio views in terms of equities, bonds, cash, and gold. Can we move maybe to the opportunistic side? I know you have a number of buy ideas. So could you maybe for our listeners just briefly outline some of the key ones?
Yeah, so we currently have 14 buy ideas. So obviously, in the interest of time, I won't take people through all of them. Obviously, people can go to the publication in the link if they're interested in some of the others. So what I'll do is I'll just talk about the ones that we've opened this month. So there's 2 within the fixed income space and 2 within the equity space. So fixed income, we've added a long 20-year US government bond idea. We think there's a kink in the yield curve. So we believe the 20-year bond is actually offers significantly more value than the 10-year bond. We've also added a global convertible bond idea. So this asset class offers reasonable value and usually performs well after the first US rate cut, assuming the economy experiences a soft landing. So it doesn't do so well if we have a hard landing. But we're also seeing signs that asset class outflows are easing. So that gives us a bit more confidence that maybe there's some tailwinds there. On the equity side, they're both 2 ideas, but around the same sector, just in different geographies. So we are overweight US. We have a buy idea on US and European healthcare. The sector generally has more stable earnings. In an environment where we expect increased equity market volatility, we see this as a valuable attribute. So we're recommending a buy idea in healthcare.
Okay, well, I think, thank you, Steve. I think that brings us to the end of the time we have available today. So thank you, Steve, for joining us for the conversation today and sharing your latest thinking from an asset allocation perspective. If I can sort of sum up again the key messages from the conversation today. First, we're trimming our allocation to global equities, but of course, it's important to put that in perspective, learn the lessons of the past, and also not throw the baby out with the bathwater. The second message, of course, is that whatever we've trimmed from equities, we've reallocated towards gold, where we're now overweight. Third is that we believe bond yields have peaked, and therefore we continue to look for opportunities to add to high-quality bonds and lengthen the maturity profile of bond holdings. And finally, falling bond yields, if anything, should support the performance of income-focused strategies, especially relative to cash, where Fed rate cuts are likely to bring yields lower. So we'll bring the conversation to an end here. Thank you so much, listeners, for tuning into this week's Through the Noise podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.